it goes back a while in the US, and it really is only in the US. It's a little strange. There are relationships which stocks influence in Europe, but they're not to the same degree as they are in the US. And I think it has an awful lot to do with how we set up remuneration, basically. Right, CEOs are paid to be a shepherd of the equity price. We could use a far less polite term if we wanted to, but let's stick with shepherds. And so essentially, that is both, to the point that even if they weren't making a profit, as long as the stock price was going up, that's all we cared about, right? I mean, it was only a few months ago where we were saying, oh, God forbid, don't make a profit, right? Because then you're not growing at your full potential and the stock won't go up as much, right? And this has created a very, very unpleasant, I think, reality and I think has huge policy kind of implications. So essentially what happens, and you can see it now, we can all see it in plain sight, tech stocks have got absolutely thumped. So what are we seeing? Layoffs. Because the minute that stock prices start falling, CEOs reach into the cupboard and they grab the cost-cutting axe, and the cost-cutting axe tends to be the thing that's directly in their kind of control, tends to be employment and capex. And those tend to correlate incredibly well with the equity market, frighteningly well, Anthony, right? And I think this is a singular problem. So we're starting to see that. And now the question is have we seen enough? And this is the big problem I think that the Fed has. I think essentially the Fed is in a pissing match with the equity market, because without reducing the value of the equity market, it is going to be hard to increase unemployment, which they've manifestly stated on numerous occasions. Now they have to be careful because they have to dance around the politics of this, right? But if you looked at the last sets of minutes, it was pretty damn clear that the target is not headline inflation anymore. It is employment. And if employment is a function of the equity market and the behavior of CEOs, then you have to keep going until you drop the equity market, because woe betide they step off, which is what all the bulls would like, right? We get this soft kind of landing in the middle of the year. We could probably get a crappy maybe Q1, but I suspect Q2 is when I think we'll slip technically into recession. Maybe we even get an ugly Q3. And so you make the technical definition of a recession, but markets tend to react, in advance of that, right? So we're bouncing in the middle of the year, everything's great. Well, if these relationships, this hyper-financialization continues to hold, and it holds extraordinarily well, I've got correlations between the S&P and some of the labor metrics that with the S&P leading that have 97% correlations, right? If that relationship holds, then in the second half of the year, if they back off and the equity market comes back, then all that labor data is going to soften and then reaccelerate. And then we'll be in a much worse place. I think, a much worse place. They'll have to really ratchet it. That's where things get really potentially pretty ugly. But that, I think, is the problem. I think it's this relationship between equity prices, the behavior of CEOs, and how that behavior manifests itself into the real economy. This is the fundamental problem. One of the fundamental problems we face here in the US.